In this week's episode of the Stock Scores Market Minutes, I'm going to explain what I mean when I say trade fast and invest slow. I'll then do my regular weekly market analysis, try to figure out where the markets are going in the near term. We'll look for some trading opportunities with the Stock Scores Market Scan and look at the trade of the week on OTLK. All right, so trade fast, invest slow. What do I mean by that? There's really two dominant players in the market today. There's the computers, which are very active, trading short-term swings and volatility. We can think of that as high-frequency trading or algorithmic trading. And then there's the longer-term institutional investors that are managing billions of dollars, taking positions for the longer term. Now, when I started trading, there was a third group, and that was the retail investor. But they're really not a dominant force anymore. And what that means is that you have got to start to look at whether you want to trade actively with the computers or if you want to trade longer term with the investors. Computers take advantage of human emotion, and we can take advantage of computers by following abnormal activity aggressively. Now, investors, they're interested in carrying those strong stocks in long-term trends that could last months or even years. And we can ride their wave by looking at the longer term charts. So if I'm going to be a trader and sort of trading off of what the computers are doing, I want to be very short term. I like to trade off of the 2-minute chart and just take advantage of short term volatility. I might only hold the stock for a few hours. As an investor, I watch the weekly chart, that longer term picture that is guided by the large institutional money that's in the market. I no longer really take my trade signals off of that middle ground, the daily chart. Now, the daily is still important, but the weekly is more important for the investor, and the 2-minute is more important for the short-term trader. All right, let's get into this week's market analysis as we always do. I wanted to show you a couple of examples first about what I mean versus short-term versus long-term trading. So this is a investor type trade, and this is the longer term weekly chart of APPS, and here you can see the stock traded with very low volatility, not a lot of life, and then it came alive on the weekly, breaking from low volatility, breaking the downward trend line, and the stock has moved very quickly. Now that's a very different type of trade compared to a day trade like OTLK, where you've got a stock that nobody cared about, and then it comes alive with volume, starts to move, and in the matter of just an hour, it's up quite significantly. And so if you're going to be a day trader, focus on that 2-minute chart. If you're going to be an investor, focus on the weekly chart. All right, now let's get into our regular weekly market analysis, starting off with the US markets and a look at the S&P 500 ETF, SPY. You can see the downward trend line was broken. We did that 2 weeks ago, and we had a nice run up. And this week, we've been grinding sideways in this sideways pennant pattern. Now, that's healthy. When a market runs up like this, you usually take a break. The fact that we haven't really broken down from a falling top means that the buyers are still in control. I think we're most likely to break to the upside out of this pattern and move back toward the all-time highs in that 295 range on the SPY. Looking at the longer term chart, you can see the nice bounce back that came 2 weeks ago, but also the very narrow trading range that we had this past week. And it's that narrow trading range and sideways trading that made the market somewhat difficult to trade for the short-term trader because there wasn't good trend for the overall market through the trading day. Now, as a weekly goes, it was fine. We held up well after the big gains of the previous week, and I think we're likely to still move back up toward those all-time highs. As I said, that's where we're going to find resistance right around the 295 level, and that's not a lot of upside until we hit that ceiling. Looking at the small cap stocks in the US, you can see that we broke some support. Now we're trying to bounce back, but this looks to me more like a flag pattern in a downward trend. And so I'd be concerned if we then break down from that flag, because that would probably mean that we're going to head toward those lows or perhaps even farther. So certainly the small cap US stocks, not as robust looking as the large cap US stocks. Onto the Canadian markets. TSX 60 stabilized this week. It also bounced back like the US market, but not to the same intensity. And like the US market, it was more or less sideways this week, but it did have a pretty promising run on Friday, and perhaps indicating some of the money coming back to some of those commodity sectors that the Canadian market is dependent upon, particularly gold stocks. A lot of gold stocks listed in Canada, and that sector is actually doing quite well right now. On the long-term chart, you can see that we are below resistance. We are trying to break the pullback. I wouldn't say we've done it with authority yet, but something to keep an eye on. This is again a flag pattern, so we had a run up, then we make this flag, which is a little pullback, and if we can break the flag, then we'll try to break into the upward trend again. The TSX Venture, which of course is the Canadian microcap stocks, lots of cannabis names, lots of junior miners, junior oil companies here, really more speculative stocks, and that is a sector that typically falls out of favor in the summer. It actually fell out of favor some time ago when the cannabis sector kind of did its thing and matured out of the sharp upward trend. And so this market is fairly weak. The cannabis group was not solid this past week. And there are pockets of strength here. With that strength in gold, you might find some junior gold miners on the TSX Venture that are doing well. But in general, I don't think there is a real strong speculative enthusiasm on the Canadian market. On to currencies, US dollar has been the dominant currency for some time. Last week it gave me some concern because it had that little breakdown and that kind of broke this little upward trend line. Well, we bounced back quite nicely this past week, and so that makes me think we're just destined to build a little pattern, one of those ascending triangle patterns, go sideways for a little while, sort of reconcile the gains that the US dollar has made, and perhaps we can ultimately break through that resistance after a period of sideways trading. The strength in the US dollar hurt the Canadian dollar, which had tried to break its downward trend line. As I said last week, it was at the downward trend line, but it really hadn't broken it yet. And this week, we saw that resistance of the downward trend line hold up. Now, that doesn't mean we can't break it soon. We do have a rising bottom. That's a positive. And so what you want to watch for is a solid break up through the downward trend line as a bullish signal for the Canadian dollar. Hasn't happened yet. Will it happen? Time will tell. But for now, I would still remain bearish on the Canadian dollar. Interest rates, we always look at the TLT, which is the bond ETF. If this goes up, interest rates are going down. And you can see we've broken through that longer term resistance. Had a little pause the last couple of weeks. Pretty typical when you get that sharp run higher. We are still above the upward trend line. So I think there could be more of a pullback, and that would still be healthy without breaking the upward trend line. It is a bullish market for bonds, which means it is a market where we expect interest rates to continue to fall. But there's a lot of expectation that the US Federal Reserve is going to cut their interest rate in the near term. And if that doesn't happen, we could see a sharp correction in this market. So the market pricing in with something like an 87% probability that the US Fed will cut rates sometime this summer. And finally, well, not finally, the commodity sector. Gold, of course, had a very good run the last couple of weeks, and then this week took a breather. Why does it take a breather? Simply because when markets rally into resistance, they usually get stuck at resistance, and we can see that on the gold chart. We rallied, we paused this week, totally normal, totally acceptable. We really have longer term resistance here, and we may try to make a push toward that, and then I expect we will get stuck and go sideways near term. Oil market has had some selling pressure the last couple of months. It was relatively stable this past week, but not showing any enthusiasm. Now I would say it is oversold. We are quite far below the downward trend line. So it would be reasonable for this market to bounce back, but I don't see any signs of a bounce back yet. So I think it's best to be cautious with the oil market. And finally, the fear chart. We always take a look at the VXXV, or the VXX rather, which is the volatility index for the S&P 500. It's an ETN, trades basically on fear, and there is no fear. You can see relatively low volatility there and at low prices, and that demonstrates that although the market was in a sort of a profit-taking phase over the last 4 to 6 weeks, we really weren't in a panic phase. It was simply a market that went up quickly, hit resistance, got stuck, and now it's trying to get back to the old highs. So I don't see any real sign of fear, and that is a good sign if you are worried about a sharp correction. So then, my ratings still remain neutral on US stocks on both time frames, long and short term. Canadian stocks also neutral on both time frames. Gold, bullish short term. We're still in that short term upward trend, but neutral long term because we are bumping up against resistance. Oil, neutral long term. It's fallen quite a bit, a little oversold on the longer term weekly chart, but not showing any sign of buyer enthusiasm on the short term chart, so I have to remain bearish on that time frame. After strong gains the previous week, this week was one of base building as markets grinded sideways with low volume. The buyers are still in control short term and they should push stocks to all-time highs, but we need to be cautious because if there is a breakdown, that will be from a falling top and that would be a bearish signal. So we want to watch out for a breakdown from a falling top on the chart of the S&P 500. Gold is stable, oil still deserves caution, and fear is low. All right, let's run a Stock Scores market scan, see if there's any opportunity. What I want to do is run the scan on the Stock Scores Simple Weekly strategy. We're going to run it in Canada, and that's mostly because I see a lot of good gold names as a sector that's leading the market. And so let's take a look and see what we find here. We're not going to go through all 50 of these, but I'm going to try to identify some charts that have some promise. What I'm looking for as I go through these charts is stocks breaking from good patterns with some abnormal activity. Now, SMF was a stock that I highlighted last week because of its break through this resistance level with abnormal activity. That's the kind of pattern we want. And I still think that this stock is worth considering because this past week it was up only slightly, and so therefore it still has promise. Moving along, I'll go through a few pages of this here. Just Energy, JE, broke its downward trend line. Not letting me draw on my chart, unfortunately, but you can see that the downward trend line was broken last week. This week it's still stable. I think that's pretty good. Rising bottom, I'd give that a 6 out of 10. Nova Gold, I don't like this one so much, even though it is in the gold sector. It's got this resistance here that's going to slow it down at around 6.5. So I think upside is limited. I'm going to go through one more page here. I just like to demonstrate the thinking that I have when I'm looking at these charts. You want to think about price patterns, about trend lines, about breaks of resistance. Here's an example of a stock breaking through some resistance right here this week. And this is something called a cup and handle pattern. You see the little cup here, the handle, trying to get through the handle. Not really through resistance at $8 yet. And look at volume. Volume is quite low this week, and so that's a negative as well. I'd give that a 6 out of 10. Centerra Gold, well into its upward trend already, so that's a gold name I would not want to chase higher. And I think that's about it for this page. Transat on speculation of a buyout. You know what, let's do one more page. Detour Gold showed some life this week, but really still going to struggle with that $15 resistance level. I think you probably better to let that one alone. Copper, ERO Copper, breaking to new highs. The trend is pretty parabolic. If I was to draw a line, it would be a curve, actually, not a straight line. And that demonstrates that buyers are chasing this a little bit. But if you own this, looks like a very good stock to hold. Buying it here, getting a bit risky. I'm going to just go through a few more, and then we will move on to the trade of the week. All right, so let's jump back to the presentation and look at that trade of the week. And this one, I think, really summarizes the kind of week that it was. This is OTLK. It was my top pick of the opening half an hour of trading today when I was running my active live webinar where people hear my commentary and my algorithms are identifying trading opportunities. This was one that was identified at that first pink dot chart at around $2.08. Nice action candle breaking from low volatility, has everything I like to see. And it went up to 3.5 RR before kind of pulling back and settling in and not really being a big winner. And that's the kind of week it was. It was an okay week, but it wasn't a real strong winning week. And that's going to happen some of the time when you have a market that's trending sideways. It gets harder for these trends to really run. Now, in this particular trade, for $100 of risk required a position size of 900 shares. So you're looking at about $1,870 in capital required. It's not really a marginable stock because it's under $3, so we have to pay for it all. That means on the 2.09 RR, reward for risk, that it earned, that's a $200 gain on $1,870 of capital. That is a 10.6% return for the one-day hold. By no means a bad return, but still not the excitement that we like to see when we're day trading. And again, that's the kind of week that it was. Well, that has been the Stock Scores Market Minutes for, June 17th, 2019. I hope that you've enjoyed it. If so, please click on the like button, subscribe to the channel, leave a comment. Most importantly, trade well.